In 2020, it looked like people were going to turn their finances around because for the first time, people didn't have to worry about paying their mortgages or their student loans. And at the same time, they still had money coming in. Maybe the government was sending them money, or maybe they were still getting paid to go to work without all the expenses. So we were seeing people build up their savings. We were seeing people invest their money, and we were seeing people pay down their debt. Well, now it looks like this is all turning back around. What's up, everybody? I am Jasprit Singh from theminoritymaster.com, where money minds rethink rich. In 2020, we had a very weird economy. At first, when the pandemic hit, everybody got scared because businesses were being forced to shut down, people were losing their jobs, people stopped making money. But that's when the government came out with their own unemployment program, and then people started making more money. And then people started going back to work, and then the government started sending out stimulus checks. So now you had a lot of people that didn't lose an income, but they lost a lot of expenses because you weren't allowed to go out and shop because malls were closed and people didn't want to go outside of their home. So people were sitting in their homes, they were stacking cash, and then the government created new forbearance programs which said that you don't have to pay your mortgages, you don't have to pay your student loans, and a lot of people were not paying the rent. So all of a sudden, you were making the same money as before, and a lot of people were actually making more money during the pandemic thanks to the help of unemployment programs or thanks to the help of stimulus checks on top of regular income. So people were making more money with less expenses. So now all of a sudden, people had extra cash and they didn't have anywhere to spend it. So people started saving, they started investing, and they started paying down debt. CNBC Make It reported that a third of Americans say that they got better with their money during the pandemic. Fortune said that Americans invested more money in the past 5 months than they did in the last 12 years. And then CNBC also said that Americans paid off a record $83 billion in credit card debt in 2020. It was a really strange phenomenon we were seeing because on one hand, we were arguably in one of the worst recessions in decades, and on the second hand, people were getting smarter financially and people's finances were actually improving because they were still making money and they didn't have the expenses that they had. I'm a money nerd, so when I read that Americans are paying down their credit card debt and now they're investing more and they're building up some cash savings, this made me very happy and I got very excited about our future. But it looks like Americans are making a U-turn with their finances because you have millions of people going back to the same bad spending habits that they had before, and now they're accelerating them. Wallet Hub just released this brand new credit card study, and let me just read you this first paragraph. It says that US consumers have started to return to bad habits when it comes to credit card debt following a record-setting reduction in 2020 that continued into the first quarter of 2021. During the second quarter of 2021, consumers added $45.7 billion to their credit card tab. That is an all-time record that nearly wiped out the first quarter paydown that we just talked about. And furthermore, Wallet Hub now projects that consumers will end the year with a net addition of $100 billion in credit card debt, which far exceeds the 10-year average of $45 billion. This is absurd. So many people had the opportunity of a lifetime to finally start building wealth because you had the opportunity to not spend money while you were still making money. So people were stacking cash, they were paying down this expensive debt, and people finally, for the first time ever, had the opportunity to start building wealth. You had a head start in everything because the government shut down your expenses. And now people are going right back to their bad spending habits that put them in the financial mess that they were in the first place. Just look at this credit card debt chart between 2019 and 2020. In 2019, we had about $75 billion worth of credit card debt. Then you see this massive crash. It looks like the stock market crash, but it's actually credit card debt crashing. In 2020, we saw a record low amount of credit card debt, and then in 2021, we broke all records again. You can just see the credit card debt skyrocket. And then if you scroll a little bit lower, it shows you that the increase in credit card debt during the second quarter of 2021 was almost 3 times bigger than the post-Great Recession average for the second quarter. When I read this article and I see the charts and I see what's going on with people's finances, the only thing that I want to know is why. Why would you throw away this golden opportunity? Why would you throw this away when you had the opportunity to build wealth literally delivered to you on a silver platter? Why would you throw away the opportunity to take care of your family when you had it given to you? But it goes to show the power of everything we talk about. Building wealth and becoming financially successful has nothing to do with how much money you're making. It has nothing to do with who your parents are. It has nothing to do with what degree you have. and it has everything to do with how you use your money. Financial education is the backbone to anyone's financial success. It doesn't matter if you're making $100,000 a year or $1 million a year. If you do not know how to use the money that you're making, you will always be broke because you do not have the financial education that you need. And so many people, so many Americans do not have that financial education, or they want to stay ignorant to this type of financial education, so they will continue to stay broke even when you have the opportunity of a lifetime just delivered to you on a silver platter. The funny thing is, if you took a survey of people who are struggling with money, every single one of them will say that if they just made more money, their financial problems would be solved. But the issue with that is more money can only solve your financial problems when you are financially educated. If you're not financially educated, more money will just make your financial problems worse. More money fixes financial problems with financial education, but more money cannot fix stupid. Look, if you want to fix your financial problems, you got to cure the stupid first. Because if you have more money is just going to amplify the stupid. So you got to take care of the stupid, and once you do that, now the more money can amplify your financial education. In the middle of a pandemic and a once-in-a-lifetime recession, do you know who came out as a big winner? Luxury brands like Louis Vuitton and Gucci. LVMH, the owner of companies like Louis Vuitton, made record sales in the middle of a pandemic, and they made more sales in the pandemic in a recession than they did prior to the recession and pandemic. LVMH is a luxury brand conglomerate, and they own brands like Louis Vuitton, Christian Dior, and Tiffany, and they are making billions of dollars more now than they did before the pandemic because people got that extra cash and they want to spend it on looking rich instead of actually wanting to be rich. Now, don't get me wrong. I don't got anything against luxury. I love luxury. There's nothing wrong with having a $3,000 purse. There's nothing wrong with driving a brand name car. There's nothing wrong with owning $10,000 worth of jackets. The only problem is if you're buying the stuff before you can afford it, well, now you're making somebody else rich at the expense of your richness. I don't have an issue with people blowing money. I mean, it's actually a good thing. You're buying something that you like and you're supporting the economy, you're stimulating the economy, you're spending money. So there's nothing wrong with spending money and having a whole bunch of nice things. The issue that I have is when people are blowing their money to buy these nice things before they can afford it. See, I have no problem if you're buying nice things and you can afford these nice things, keyword afford, not just buy, because there's a difference between being able to buy something and being able to afford something. But the issue that I have is you have so many people buying these expensive, nice things before they can actually afford it. I was talking to a handyman / contractor that I know the other day, and he was telling me why he didn't want to buy this bigger home. He said that he really liked the home, but the issue was if he bought the home, he would have a very expensive utility bill. He'd have to pay for more electricity, he'd have to pay for more gas, and he didn't want to have to do that. But the issue is if you're buying a home and you're concerned with buying this home is how much your utility bills are going to cost you, your priorities are in the wrong place. You probably can't afford that home if you're worried about what the utility bills are. You need to figure out what you can really afford if you're worried about paying the gas bill. Anytime someone starts talking about their financial stresses and why they're struggling financially, you start to see the blame game. People start to point fingers. It's the government's fault. They're not taxing the rich, or the government is taxing me too much, or it's my corporation's fault, or it's my boss's fault, or it's somebody else's fault. We just keep pointing fingers, pointing fingers, pointing fingers. But what you got to understand is when you're pointing your finger at somebody else, you got 3 fingers pointing back at you. There are issues in our economy. We are seeing rising inflation. We are seeing the rising cost of living. We are seeing things become less affordable. You want to go to the grocery store? It's going to cost you more money. You want to go on a vacation? It's going to cost you more money. You want to go out and buy a home or rent a home? It's going to cost you more money. This is the reality of the economy that we're living in. And yeah, this is somebody else's fault. This is because of all the money printing. This is because of bad regulations. But at the same time, you are also the person spending money on things that you don't need. If you have or if you finance your newest iPhone and you're driving around in a finance Beamer and you're wearing these designer clothes and then you go around saying that the reason why you're struggling financially is because your grocery bill is $50 more, something is wrong with the way that you're running your finances. The saying is, when there's a will, there's a way. If you really want the brand new pair of Jordans, you will find a way to go out and buy it. You will do whatever it takes. Cut back your costs. You will earn more money. That way you have the cash to go out and buy these Jordans. If you really want to wear a Gucci wallet, or if you really want a Louis Vuitton purse, you will find a way to get the cash to go out and get it. You will do whatever it takes. You will make the sacrifices. You'll find a way to earn some more money. That way you can get the money to to go buy this luxury item. And if you want to start building wealth and you really want it, you will find a way to cut back your costs and earn more money so you have more money to build your wealth. America is known as the land of the free and the home of the opportunity. That's why so many people are willing to literally risk their lives to come to this country. And the reason why it's known as the land of the free and home of the opportunity, because you are free to spend your money as you please, and as the home of opportunity because you have the opportunity to build wealth if you so please. It's not easy. That's why the majority of people will never do it, but the opportunity is there for the minority of people who want to seize this opportunity. My grandparents were refugees. When my home state of Punjab was severed by the Indian government in 1947, my grandparents lost everything. They lost their home, they lost family members, they lost their money, and they had to literally pick up and run for their lives with a sword in their hand. My grandfather saw his uncle get killed right in front of him because someone slashed him with a sword on the head, and so he had to continue running. By the time he got to the new side of India, he didn't even have shoes on, and he had to find a way to make it work. My parents grew up in India where you don't have the same opportunities that you do in the United States, and in the 80s, when our home state of Punjab was bombed by the government, that's when my dad said he wanted to leave. So then my dad left India, came to the United States with less than $100 in his pocket, didn't know the culture, didn't know the people, but found a way to make it work. I didn't grow up learning about financial education or investing or money, but the reality is if you are born in a first world country and you have the ability and the means to understand and watch this video, you have everything that you need if you want to become successful. Now it's up to you. What are you going to do with all the resources that you have around you? Are you going to blow it? That way you can look rich while you're actually making everybody else rich and then just complain about how the system keeps screwing you over? Or are you going to learn how money works? That way you can take care of yourself, that way you can take care of your family, and that way you can take care of your community. The freedom and the opportunity is there. The decision has to be made by you. If you enjoyed what you saw so far, then you're going to love this. The whole idea behind compound interest is you're going to invest some money today. This money is going to grow, and now you have your money working hard to make you money, and the money that your money made working hard to make you money. So it's almost like your money is having babies, and your money is just going to keep compounding and growing, which means you have more money working hard to make you money. Even if you're not investing your money in the traditional sense, you should hopefully still be earning this type of compound interest, because if you go to work every single day, you're compounding your knowledge and your skills. And so the longer you go to work, the more skills you're going to learn and the more valuable you're going to be as an employee. That's why as you get older, your pay should hopefully go up too, because you're compounding your knowledge, you're compounding your skills, and now you're more valuable, which means you should be getting paid more money. It's the same concept with your money, except more money doesn't give you more skills, it just gives you more power. Like this $100 bill doesn't have more skills than this $20 bill does, it just has more power, because assuming that $1 will buy me a machine that's gonna make me a nickel, now with this $100 bill, I can buy 100 of those machines. With this $20 bill, I can only buy 20 of those machines. So I'm going to be able to earn more nickels with this $100 bill than this, just because I got more power with this piece of paper than this one. But this is where compounding becomes so powerful, because every dollar I earn will buy me another machine that makes me a nickel, and I need 20 nickels to earn a dollar. This $20 bill will get me 20 nickels, which will buy me one more nickel making machine. This $100 bill will earn me 100 nickels, which will buy me 5 more nickel making machines. So I'll be able to earn more nickels with this just because I got more buying power. The more dollars you have, the more dollars your money is going to be able to make. And the longer you let your money sit there and invest and compound, the more your money is going to be able to grow. That's why Albert Einstein calls compound interest the 8th wonder of the world, because now your money is working hard to earn you more money, and every time your money does that, you're going to have more money that you can send out to work hard and earn you more money. So it becomes a system, almost like this machine that's just working to produce you more money, and anytime you produce more money, you can buy another machine that's going to be working to produce you more money. You don't need a ton of money to start, but the longer you have, the more your money is going to be able to grow, which is why you're going to see the biggest returns towards the end of your compounding. Like even if you start with just 1 penny and you can double your money every single day, day 1, you have just a penny. In day 8, you have $1. By day 21, you have $10,000. Now your money is really starting to grow. And by day 30, you're going to have over $5 million, and you started with just a penny. Now, I already know what you're thinking. But Jaspreet, if it was so easy for me to double a penny, I'd already be doing that right now. Now, I know it's not easy to double your money every single day, and that's not the goal, but you can do this over time. There's a couple different strategies that you can follow to compound your money and really build your wealth over time. There's an active strategy and a passive way. Actively compounding your money is literally what the word says it is. You are being active and you are buying something, selling it, and now you're using your profits to go buy something else. You see this all the time in real estate. You go out and you buy a $100,000 property, you renovate it, whatever, you fix it up, and you go sell this property for $150,000. Now instead of going and buying another $100,000 property, you go out and you buy a $150,000 property and you renovate it, and now you sell it for $225,000. And so slowly you are growing your money and compounding your money because you can do bigger deals. Now you can do 2 deals at one time. You can do $200,000 deals and hopefully sell both of these for $150,000 each. And now you're just compounding what you're doing. You're slowly growing what you can do because you make some money and you take your profits and you reinvest it into whatever it is you're doing. This is exactly what I do on YouTube. Anytime somebody watches our videos on YouTube, I get paid. Thank you for your penny. Now, when I get this YouTube money, I can take all of it and go out and buy myself some new exotic cars, go get myself a new Gucci wardrobe, and go enjoy some fine dining at Chipotle with some extra guac. But what I actually do with this money is I reinvest this money back into our business. That way we can grow our business bigger. I'm reinvesting it back into our blog, I'm reinvesting it back into our newsletter, and I'm reinvesting it into an app that we're making. I'm actively working to compound this money by sacrificing some of these luxuries today that I could buy by reinvesting this money back into the business. That way I can grow the whole pie bigger. When I was in college, I started a cell phone accessory business with a friend of mine, and we didn't have a ton of money, and we wanted to start selling these like cell phone battery packs, and at the time we only bought like 10 of them because that's all we could afford. And so we bought 10 of these battery packs and we sold them, and then we took this money that we got and our profits and we went out and I think we bought 20 battery packs, and then we bought 50, and then we bought 100. And so it was like a slow compound where we took whatever money we had to buy these battery packs, we sold them, then we took this money and our profits and we compounded it, and that way we were able to buy more, sell more, buy more, sell more. And so you don't get to enjoy the profits when you're compounding it like this, because if you're taking all of your profits and reinvesting it, you're actively compounding it to grow the whole thing bigger. When you do this, the hope and the whole idea is you're gonna start off with something small, $100 or $1,000, and you're gonna grow it to something a little bit bigger. You're gonna turn $1,000 into $2,000. Now you're gonna reinvest the $2,000, turn it into $4,000, then the 4 to 8, the 8 to 16, and you're gonna slowly keep growing it. There is a risk though, because if you keep growing it and you don't take out any money for yourself, eventually there's a chance that things don't work out. And now you grew your $1,000 into $100,000 or $1 million, and then things fail, and if you didn't take out any money for yourself, now you're left with nothing. So if you're doing this type of active compounding, you really just gotta find the right risk balance for you, because anytime you pull a dollar out, that's a dollar that you cannot compound. But if you keep the dollars in there, then you take on more risk. I mean, this is one of the things that made Elon Musk so financially successful, because in the early stages of his career, when he would make $25 million, he would reinvest all of this money back into his business, and he would leave nothing for himself because he wanted to compound and grow his dreams and his wealth by taking every dollar he had and throwing it back into his beliefs. The second way you can compound your money is the passive way, and this is what a lot of people think about when they think of compound investing, because now what you're doing is you were taking your money and you're putting it into an investment, and you're gonna let your money grow, and anytime your money makes money, you are gonna reinvest that money back into it. That way this money that you have growing is gonna keep growing even if you don't add money into the pot, because your money is growing and this new money is gonna be working to make you money too. When I was in high school, anytime we talked about compounding or investing your money in my math class, the example that my teacher always gave me was investing your money in a CD in the bank or a savings account. So the way it works is you put your money in the bank, either in a CD or a bank account, and then your money is going to grow, and as your money sits there, it will compound and grow, because now this money that your money made will grow even more. But the interesting thing about this, so if we write bank account, you're not going to get a very good return, especially nowadays. A savings account nowadays is going to pay you like 0.1% if you're lucky, and a CD is going to pay you 1% if you're lucky. So if we look at this where you get a 1% return on your money, and I'm being very generous here, it is going to take you a long time for you to double your money. At this rate, keeping your money in the bank is going to take you 72 years to double your money. So you're not building wealth in this lifetime. Maybe your great grandkids will have some decent money to play with. If you're really looking to compound your money and grow your money, then you need to be putting your money in assets. So this would be things like the stock market. If you're investing in your money in the stock market, the goal is to grow your money by investing in companies that you believe in, because over time these companies are going to make more money, which will make the stock price more valuable for you. Now, if I come back here to active, if you do a business or flipping like we talked about, there's really no limit or kind of a baseline to how fast you can grow your money here. I mean, it's not super unreasonable to see 100% growth in a year, so it's really kind of uncertain as to how good of returns you'll see. It just depends on what it is you're doing and how good you are at it. So, there's really no baseline here. The stock market, on the other hand, has gone up by between 8 to 10% a year historically. So even if we stay on the low end here, 8%, you're going to be able to grow your money much faster. And the thing you got to understand about the stock market is there's a couple of different ways that you can make money. You can make money through appreciation, which is when the price of your stock goes up. And you can also make money through dividends, which is when the company that you invest in literally just gives you a cash check. So if you can grow your money by 8% a year in the stock market, you can double your money every 9 years. That's a whole lot better than 72. Now, if we kind of really look at compounding your money, this is where a lot of people assume that you have to invest in dividend-paying companies, which are companies that pay you cash payments. That way you can compound your money, because in that case, when you get this dividend, then you could reinvest this dividend back into the stock market and buy more shares. That way now your money is actually growing. So you invest in a dividend-paying company, this company gives you some cash, then your money automatically gets invested. That way you can own more shares, and now as you own more shares, you're going to get more dividends. As you get more dividends, you can buy more shares. So it creates this reoccurring cycle of growth and compounding. This dividend reinvestment strategy is a great way for you to build your own wealth, because now anytime you get paid, you're going to automatically reinvest this money. If you want to learn more about how to do that, our team broke this down in an amazing article on our website where it shows you, one, how to do this reinvestment, how to invest in companies, and how to find a good brokerage that does this. So if you want to learn more about how to do that, I'll link the article for you in the description below. But what I also want you to understand is that not every company pays a dividend. The only companies that really pay dividends are really your more established and more mature companies, because these are companies that at the end of the year, they have so much cash in their bank account, they have no better use for their money. Because if they could reinvest this money back into their company and grow their company bigger, then they would probably do that. But they have so much cash where they're just like, you know what, let's just start giving it away to our shareholders because we have no better use for this cash. And so people assume that the only way to compound their money is to invest in dividend-paying companies, because these are companies that are giving you cash, and when you get this cash, you can reinvest it. But you can also compound your money by investing in companies on the stock market that are reinvesting their profits. If you find more of a startup company that you really like and you really believe in and you think is a good value, and you invest in this company, and this company, anytime they make money, they don't give it away in dividends. They take this extra cash and they reinvest it back into their company, so they're really not making that big of profits. Like how Amazon during the early years of it being public never made any money, because anytime it made money, it reinvested it back into the company. If you invest in a company like this, then your money is still compounding, because you own shares of a company that's using all of its money to grow itself. And so while you're not getting this cash payment and accumulating more shares, your shares become more valuable because of this compounding, because the company that you're investing in is compounding all their money because they're taking all of their profits and reinvesting it. And there are pros and cons to both, because this type of investing, where you invest in more of a startup type company, has more risk, because there's a chance that this company will fail, like we talked about here. If you're actively compounding your money, which is what this company is doing, there's a chance that it could fail. And so yeah, they're reinvesting all their profits and they're doing everything they can. But if this strategy fails, then there goes your investment. But on the flip side, with these dividend investments, because these dividend paying companies are typically larger and more mature, you're going to have a safer investment, which usually comes with a smaller return. So you might not see the stock price go up as fast, and your average dividend is typically somewhere in the 2 to 4% range. It really depends on the company, so it's not anything huge, and hopefully it will go up over time, but you just got to kind of understand where you want to be. It comes with lower returns here, higher potential returns here, but more risk. The second thing is with dividends, anytime you get paid a dividend, you have to pay taxes on this dividend. So while you take this dividend and you reinvest it, you still have to pay taxes on the money that you made, even though you don't actually get that money in your bank account, because you're, in this case, reinvesting that money. Another way that you can compound your money is by investing your money in real estate. This is my actually favorite place to invest my money, because not only do you get passive income, if you do it right, you will also get the appreciation in the property. And so with real estate, when I invest my money, I'm looking for a 7% annual return on my money, cash on cash minimum. Ideally something closer to 8%, but 7% is my real minimum. Now the thing that you got to understand here is that if I get a 7% return on my money, it's going to take me 10 years to double my money. But in this case, the 7% is a cash on cash return that I'm getting every single year in my pocket. So if I buy a $100,000 property, that means every year I'm making at least $7,000 in profit. Hopefully over time this is going to go up if rent prices go up, but that means I'm making $7,000 a year. And now what I can do is after 10 years, I will have this cash in the bank that I can use to go out and buy another property, or I can just take my own cash, go out and buy another property and supplement it with this money that I'm making from real estate.
The reason that real estate becomes so attractive now on top of this is because not only are you getting this cash flow, but if you're buying your properties in a good area where people want to live, then you're also going to see the property value go up too. So I buy this $100,000 property and every year I'm getting $7,000 a year in passive income, but over time this property might go up in value to, let's say, $200,000. And now if it comes time for me to sell this property, I sell it for $200,000, I can do something called a 1031 exchange. It's a little loophole in the real estate world where now I can take all $200,000, pay $0 in taxes, and go out and buy a $200,000 property that's going to pay me with more passive income. And so when I try to do that in the stock market with dividends, the first thing I had to do was pay taxes on my dividends, and then I could reinvest these dividends. With real estate, if the property value goes up, now I can sell the property, pay no taxes today on those profits, and go out and buy myself a bigger property that's going to pay me with more money. Plus, even on the passive income, the cash flow that I'm making from real estate, this money that I'm getting here, there's a lot of tax breaks that I get with real estate that I don't get with the stock market. So even as I get the $7,000 a year in passive income, I don't have to pay taxes on all $7,000 because there's other tax deductions that I can take, like something called the depreciation tax deduction, which says that I get to get a deduction because my property is 1 year older. So happy birthday to your property, you get a tax break. So from a tax perspective, you get more benefits here from real estate, but real estate does come with its own downfalls because now you have to deal with more people. Like when you're investing in stocks, you're not dealing with anybody. You can go out and buy shares of Amazon or Lululemon or Chipotle and McDonald's and not have to deal with a single person. You can do this right off your phone. You want to go out and buy a real estate property, you got to have a real estate agent, you got to have a property manager, you got to deal with a contractor, you got to deal with an attorney, and you got to deal with tenants. And so if you don't want to be in that game, the stock market is better for you. Plus with real estate, you're in charge. You're the one that actually has to make sure that your property is generating income, and it's more work on your end because now you got to be the one that's negotiating the deal. And if your tenant doesn't pay or if your tenant damages the property, that's a cost that you have to pay. And of course, the most obvious thing is that it takes a lot more cash to start investing in real estate than it does to start investing in the stock market. I mean, you can start investing in stocks with as little as $100, but if you want to go out and buy a property, you can't do that for $100, at least not a good property. Now, while it's your decision on where you want to invest your money here, here, or here, the idea stays the same, that you need to compound your money. The whole idea behind that is anytime you make money, you want to reinvest at least some of it. That way your money is growing and the money your money made is growing. That way you can grow your money quicker and quicker and quicker over time, because the real secret to building wealth is investing. Yes, we talk about that all the time, but if you really want to grow your money quicker, you got to compound your money, which means you got to have more money in the fire that's burning to make you more money. But I guess if you're burning money, that's probably not what you want to be doing. So bad example, but you got to have more money working to make you more money. Thank you for watching. If you enjoyed this video, here's a video on how to build wealth that I think you'll love. And while you're at it, download our free guide on how to start generating passive income. And as always, keep hustling. The second money trap you want to avoid is falling into the 0% APR game. If you walk into the electronics store and you got $600 in your pocket to buy a TV, and you start looking at TVs and you find one that you like,